So, for the last many weekends, my kids and I have gone to, and if you know this, if you know where this is, Wilder Fields. If you go through the 24 tunnel, the first exit, it's across from Shakespeare, the Shakespeare Festival Park, the theater there, and there's a road that goes up to the right, and there's about 5 soccer/baseball fields, and a whole new housing development. And there's really big houses. It's kind of an interesting area. But I've been meeting my brother there and my nephews with my kids for the last couple months. And when we've gone for the last few months, we've gotten there and we've kind of had a field to ourselves. Sometimes we've had to share that field with somebody that's throwing a ball with a dog, but usually it's just been us and the person with the dog. Yesterday, we got there and we were shocked because the parking lot was completely full. As we drove in, there are 2 fields down below. They had full side games going on of baseball or softball. I didn't see which, but there's a bunch of people in the infield, some outfield players. The dugouts were full of players. There were people leaving the parking lot with coolers and chairs in their hands, and they were gathering. And there was very disturbingly few masks, and no one was social distancing anything. People were using the public bathrooms, and it just seemed like no one knew what was going on. We got to our field, which is the 3rd field up at Wilder Fields, and there was a 10 versus 10, full goal game going on. They were on shorter fields, so they left us some space off in a corner. We had probably a 30 or 40 yard square space. 2 of the players on the field had masks on. The other 18, 20 players did not have masks on. There was no attempt at social distancing in the game itself. And by the time that game ended and the next game started, there was another couple of coaches and players that were doing some one-on-one drill work and some work. None of those folks had any masks on or attempting social distancing, standing right next to each other, huffing and puffing as they're breathing and playing soccer. And then by the time we were done, the 4th field, the field above us, had some kind of an art festival going on. And there were hundreds of people milling about. Some of them had masks in this crew and some of them didn't, but social distancing wasn't possible. So, it makes complete sense to me that we're in the middle of new highs of infection rates. And we're seeing the death rates actually tick up again after being in decline for the last 2.5, 3 months. It goes without saying that a lot of the catastrophists are coming out and saying that, all the varied ways that this kind of pretends a potential end of the economy or eventual damage to the markets. And I just want to remind everyone that back in January, February of 2020, and actually, leaning over into March, among the thousands of economists and strategists out there with deep roots in both sort of fundamental access to reams of information and boots on the ground globally, exactly out of all those people, none of them predicted the combo of the fastest, steepest decline in market history, followed by the 9th best quarter of all time. No one knew anything, but everyone was talking. And I say this because we're in the middle of the mid-year update season, and you're going to see all these pundits talk about, what they expect and what they're thinking and what they're looking out for. And you cannot ever believe a single pundit. You can't fall in love or become enamored with one person and what they're saying, even if it's us. Like, nobody knows. The fundamental here is that it's completely unknowable. No matter how we want someone to tell us what's going to happen, mindfulness applied right now is mindfulness of the limitation of our knowledge. The short to intermediate term course of the economy and the markets is always perfectly unknowable. We can't know what's coming around the corner. Because of this impossibility to know, because it's impossible to make investment policy based on short-term outlooks, those of us who try to claim some kind of intelligence about this have to do it in a different way. we have to admit the limitation, and we've got to look for the right way to make a difference for clients. And our biggest job as advisors is to change the focus from the totally unpredictable short term to the higher probability effects of maintaining a goal-focused and planning-driven stance. So I hope this makes sense to folks that are listening live today and to folks that will be listening this on its recording. And at the same time, I'm going to invite folks to read our client letter that's going to come out in the next week, and we're going to probably put it up on our blog as well. And to come and if you're interested, consider getting on our email list, and we're going to send you an invite to our halftime report. Now, our halftime report isn't a prediction. It's a Scott, you want to say something?
No, it's definitely not a prediction.
Okay. You were worried I wasn't going to go there. That's good. So it's not a prediction. We're going to make fun of a bunch of other predictions. We're going to talk about what we think might happen, and we're going to talk about some of the, our base case, our positive and our negative, and we're going to talk about what we've done in the recent past and what we're thinking about or considering doing in the future on behalf of our clients. Now, with that as a beginning, and just before I get into any of the indicators that we're looking at, both the high frequency indicators and some of the longer running things, I just want to see if anyone else wanted to say something here. Scott, John, David, if you have something you want to pop in there, just let me know. And before we get to the actual economic data that we're seeing. And that's a no. Oh, it is. There we go. Go ahead, Scott.
Yeah, I just think it's really important that the two things that I think are really important is that clients, community, whoever, is just not focusing on headlines, because headlines would have had you completely out of the recovery we've seen so far. And what's happened just today, which I think is really new information, is not only is the NASDAQ recovered completely from the losses of 2020, it's at all-time new highs. The S&P now has gotten in the game, and the S&P has literally erased all of the pandemic losses. So it's now positive for 2020. And so that's the first piece I think it's important. And the second piece is reminding people that we don't just invest on US soil. And so while our country appears to be in some sort of shambles with this coronavirus, a lot of other countries are thriving and doing very, very well in all of this. And we're global investors, and I can't emphasize that enough. I just wanted to make mention of that.
That's great. In fact, when you look at the last 6 weeks, the position that we've held that's actually been a big drag for us over the last 6 weeks has been emerging markets. In the last 6 weeks, it's actually turned, and it's now our leading piece. Oh, so it's and you never know. No one rings a bell when that turn is coming. So you always stay broadly diversified and kind of wait for that to happen, and knowing that eventually it's going to happen, because that's where value lies, right? So that actually leads to before we get into the data, there's a question that did come in, and it's regarding the uncertainty of school reopenings. Once a decision is made, do you foresee this having an impact on markets that's not already priced in? So when schools, it's a great question. It actually speaks to the economy, the markets, and more so to the personal dynamic of this stuff. And one of the big things happened when schools closed. They closed basically across the board. You heard schools in almost every state across the country close all at once, or not all at once, but tiered in, or over a period of time they were all closed. What we're going to see with the reopening is we're going to see right out of the gate a whole bunch of places are going to reopen, and kids are going to go back to school. And what this means is, rather than having a complete closure where all those parents have to stay at home or figure out a way to manage childcare, we're going to have it's going to be partial. We're going to have some parents that have the ability to go back and go to work, and some parents don't. So in terms of economic impact, relative to closure, this will be better than closure. And so the next part of that question is has this already been priced in? I think this has been priced in. So that the question, or the real surprise, will be how many of those places, if as a percentage, how many we think will take students in, and then how many actually do. That's the first part. And the second part is how many of those that take their students in, that students go to school, then go, you know what, this didn't work out and have to close. So there's things that we anticipate, and then there's the surprises that come after. I think that there's a lot of that anticipation is in the market. The surprises aren't in the market. And I think, we have to wait and see. Again, we can't make investment policy out of chaos theory, right? We have to actually have some data come in and see what happens. I think John wants to say something. I saw him take his mute off. What a great signal that is.
Not really.
Oh, you just took your mute off. What's with the signal with no? It was noise. It wasn't signal. It was just noise.
It's like emerging markets. You just never know where it's going to turn. Can't tell.
All right, cool. Let's talk about. Oh, and by the way, I haven't done this in the past, but I want to make sure that everyone knows this. The place I get the majority of our data is this place called Crossing Wall Street. It's this gentleman named Eddie Elfenbein. He reports, every piece of data that comes goes up on his blog immediately, and I would definitely take a look at it if you want to actually pay attention to stuff and watch it. He looks at a lot of stuff. He's showing it all from every source, and it's kind of an unbiased here. This was the expectation. This is what happened. And so if you ever want to track the stuff in real time, you can actually follow that blog, and it's a good resource. There's a lot of them. That's a good resource for a lot of general stuff. So we look at 13 high frequency indicators, and of these 13, I'll just list a few of them. There are initial jobless claims. There are continuing jobless claims. There's an ASA staffing index. There's box office receipts. There's some rail car traffic. There's hotel occupancy. There's TSA checkpoints. There's the open table data you've heard us talk about. There's gasoline usage. There's lots of these little things. And what we've seen, interestingly, the last number of weeks, we've seen both month over month and week over week improvements. What we see this week is we see a month over month improvement across the board. 12 of 13 of these are positive. Week over week, though, we have 4, 1 that doesn't have data, and 3 that are negative. So what that's an indication of is that the improvement's not going to be in a straight line. What that means is, in the 2 things that went up and then came back down, 3 of the things were box office receipts, rail car traffic, and open table. So we had a whole bunch of positive for a number of weeks in a row, and now we've got 1 week where those 3 things have turned negative. They haven't turned hugely negative, but they're negative, and it's worth noting that the improvement that we've experienced to date has taken a brief pause in 3 of 13 categories. Now, again, it's never going to happen in a straight line. It's always going to take time, and it's always going to bounce around a little bit here and there. But this is part of how progress occurs in the economy. Yes, Scott?
Does that mean that 75% of the indicators are continuing to improve and only?
Yes.
Okay, well, that's still a very good sign.
Yeah.
Okay.
And those improvements are mild. They're 2% here, 3% there on a week over week basis, but the majority of the indicators are still positive.
Right.
I imagine we come back and do this in a couple of weeks, maybe because we'll probably see a continuing uptick in infections because we can't seem to get our hands on that. And if we see a continuing uptick in infections, we'll actually see the continuation of more hospitalizations and more death. And with that, you'll see more fear, and people may pull away some from open table and pull more away from travel. And so we might see a couple more of these things tick into the negative, or we may see some increased negative. Again, not predicting, just kind of looking at how things might progress. And then I just there's a couple notes that are worthy of mentioning, because last week or 2 weeks ago when we did this, one of the things that came up in the conversation was, how come Warren Buffett's not, maybe it was a month ago this happened, one of the things that came up in conversation was, how come Warren Buffett's not, he's got $120 billion of dry powder, cash that he's sitting on. How come he's not engaging? And we talked about one of the responses he gave in the media was, well, the Fed kind of did that for us. The Fed kind of did everything that we would normally have been backstopping. The Fed kind of stepped up, and they are now the backstop. They provided capital where it was needed. But we did see in the last couple of weeks, we saw they made a move. So Berkshire Hathaway purchased Dominion Energy's natural gas assets. They spent $10 billion on acquiring natural gas assets. So that's the first step, the first foray for Warren Buffett since COVID hit the economy and the markets. And the second thing that's kind of worthy of notice today, I think, is this week we kick off earnings season. And there's going to be a lot of bad news in this. We're expecting, earnings to be off over 40%, but I want to put that in perspective. Our expectation for earnings was about 38 to 41, depending on who you talk to, 38 to $41 per S&P share, and that's if you put all the companies in the S&P together as one company, you'd expect 38 to $41 a share. What we're expecting now is 28, 27, 28, 29. So still, these 505 companies are looking to be, on average, profitable, which means they've had a decline in purchases of their goods and services, and they've had to manage their costs to remain profitable, which is why you see 20-some million people continuing unemployed, and that's why you see purchasing manager indexes where they are. It's why we see all the other data that's negative. And so the earnings are the thing that sum up the negativity in the economic and the market environment. So I want to talk about, with that, we're going to see in the next couple of weeks, in the next 3 weeks, we'll see the bulk of earnings come in, and we'll kind of know what the damage is. The thing that the street is going to look at, the thing we're going to be watching is what's guidance like? What are companies expecting? Most companies, I'm going to assume, two things. First thing is they're going to steer guidance down. And they always steer guidance down in anticipation of having the opportunity to outperform guidance. They always like to succeed by presenting better numbers than were expected of them. Okay, so they're gonna guide down. Second thing is, in their guiding down, you need to look for, especially in the financial services world, loan loss reserves. So there's a way to manage the books. If you have an expectation of massive loan losses, or even if you don't have an expectation, you can actually add to loan loss reserves. That is a hit on current earnings, and you can then release that in future quarters and years in order to enhance earnings. Because you can say, oh, we didn't have, our loan losses weren't as bad as we expected. So there's a lot of games that get played in the data here. So when you're looking at earnings, especially in financial services, one of the things you have to do is peel out and look at what these loan loss reserve numbers are. This was huge in 2008. I actually anticipate this can be pretty big now as well. So a few more. I just want to remind everybody, if you have a question, pop it in the chat. If you have another question, pop it in the Q&A. Scott.
I think one thing to also make mention of is the idea of guidance. A new phenomenon that we've seen, is companies are just pulling guidance completely in the spirit of coronavirus because they have no visibility at all. And we shouldn't be surprised to be seeing some of that as well. And that's becoming more and more common.
Yeah, great point. Great point. Some things we just can't know. And that goes to that, the complete and utter unknowability of the immediate future. We just can't know. They can't know. Asking them to predict is silliness. We have to look past this, the intermediate term. So I want to offer just a couple more items that are positive and some items that are negative. And this is more the slower data. We talk about the high frequency stuff that we see a lot, and we also talk about some slower stuff. So this is a positive. Just markets have stabilized largely in the face of increasing infections, in the face of, some really truly insane political headlines. Like, there's some stuff that's happened in the last, 3 years, but especially in the last couple of months that are just ridiculous. You'd expect them to have massive impact, and there's just no impact. Markets are literally ignoring what's happening in the White House, mainly. Another positive is mortgage applications were expected to decline, and they actually increased, I think, by about 5%. Jobless claims, this is the weekly number, continues to fall. Continuing claims continues to fall slowly. Interestingly, in the last couple of weeks, we've seen an increase in job openings. So there are postings for jobs. There's something we've talked about here for the last number of weeks, and that is, or number of months actually, those retail and restaurant companies who took PPP loans, they are having a hard time bringing their people back and they need to bring their people back to get forgiveness but they're having a hard time bringing their people back because the federal bailout money in terms of the unemployment benefits was huge. And evidence of this is you can just look to my son, who's been trying to get a job and get some more serious hours at Saul's here in Berkeley. He went in last Tuesday to do kind of an overview of what a job might be. And they said that, yeah, you can come in, we'll give you 2 shifts. And that's a function of the inability to get people to come back to work. And I think there's 2 reasons that people won't come back to work. One is their unemployment benefits are actually really, really good. Second reason is fear, is concern about their own health. So I'm a little worried about him going to work at Saul's and being in contact with people. But he's gone there, and Kate was there when they did the overview of what the systems and the processes would be, and they're not doing in-room dining. He's going to be running food from the kitchen to the tent for delivery, kitchen to the tent for delivery. So he won't have a lot of contact with the public. He'll have contact with one person in the kitchen, one person in the tent. But he gets that job because the folks at Saul's need somebody to come in and work, and they can't get their people to come back necessarily. So job openings are rising, some for that reason. Another thing, non-manufacturing PMI turned expansionary. So this is the Purchasing Managers Index. We have double-digit gains in production, in new orders, and employment. So that's actually a real positive. On the manufacturing side, still not expansionary, still negative, but it's improving, still in negative territory. Some bad things, we already talked about this. The record infections, not good. Death rates ticking positive, not good. Wholesale trade fell, producer prices fell, and same-store sales fell. They're falling less, but they're still falling. So that's just a few of the longer-term data that's showing up, and I think we can say it's mixed data. It's not overly positive, it's not overly negative, and we're going to see it location-specific over time. That is all I have for prepared comments. John, we always want to look to you for some comments on what you see in the real estate world or what you hear, because you do have someone in your household that's pretty, finger on the pulse. Just want to see what you're seeing.
Yeah, very good.
The number of active listings, those homes that are on the market, it's up 2% from Richmond to Oakland and everything in between, including Alameda. So that whole swath of area. And at least at my wife's brokerage firm, prices are up the sales prices are up 5% over last year.
I don't think that's a surprise given interest rates.
True. And weekly, more and more homes are coming to market. So inventory is rising. And I mentioned this at the last meeting. My wife had a successful sale, 22 offers. And these were strong offers. So, like I said, that means there's 21 families or individuals out there that are still in the search.
Right. So is there any, do you know offhand any data on terms of those listings that are come on the market? Are they staying on the market longer, or are they getting purchased pretty quickly?
Oh no, they're getting purchased quickly because you can't hold a traditional open house any longer. And the usual scenario was, have a house on the market for 2 weekends and then hear offers. Well, you just can't spread it out now. Everything is on. My wife does a virtual open house on Instagram. So she's walking around the house with her phone, doing a virtual open house per se, and the realtors and their clients are watching that. Then they set up appointments to come in, but it can only be the realtor and two people, so the whole family can't go in, grandpa, grandma, parents, etc. Anyway, it's shortening the entire process. So it's a house can go on the market. A broker's tour in our neck of the woods is on Thursday. They'll have a virtual open house and showings, say Friday, Saturday, Sunday, maybe Monday. Hear offers that Tuesday or Wednesday. So
wow! So a 3-week process is compressed into 5 days.
Yeah. Yep.
I did not know that.
I'm not saying that for every listing that's out there,
Right.
but the transactions my wife has had, and she's had quite a few in just the past couple of months, it's been compressed.
Wow. Oh, that's interesting. I didn't know those details. What was the question I had about real estate? I lost it. David, do you want to? I mean, you're paying way more attention to, not that the rest of us aren't paying attention. You're paying more attention to the political landscape, and I'm just wondering if you had a thought about. I know Scott's shaking his head like, "What are you doing, man?" If you had a thought about the last couple of weeks, and if you want to add anything.
So I think it's interesting to look at the market, and as Scott was saying, basically we're up for the year across the board at this point. I think that's entirely due to the fact that the Fed has backstopped the market, and you have this sense that it's completely divorced from reality in some ways. So it's a measure of confidence in one sense, but I also think that we should not preclude the very real possibility that we're going to see some greater volatility going forward. And because this pandemic is getting much, much worse, it's also now hitting red states, which was not the case before. If you look at places like Phoenix, as of yesterday, I believe there were 0 open ICU beds in the entire Maricopa County. I mean, Phoenix is the 5th largest city in the United States. There were 0 beds available. So, you're looking at conditions in Florida, Texas, Arizona now that are comparable or worse than New York was in April. And that is going to have chickens come home to roost. This is not going to be without its impact. From a political standpoint, the administration continues to act as if nothing is happening. It's like, if you listen to Trump, there's no pandemic. It's just an extraordinary level of denial, which in many ways is comparable to Herbert Hoover during the Great Depression. And there's a lot of similarity, I think, between what's going on in this administration and that administration, in the sense of, you have a pre-Roosevelt administration which did not feel that government was the sort of backstop of last resort for people in the society. And, this thing going on about opening the schools, one of the analyses that I read is that it's basically DeVos came out with a statement that she wants to see money distributed to private schools as well as public schools. And this is it's a bad trend from my perspective, but that's basically what they're trying to engineer in this administration. I also did not know that part of what's been going on during the pandemic is that the government, to the extent that the federal government has done anything for the states, it has bought things, but then it has relied on private distributors rather than public distributors with regard to how these things moved out into the states. And it's another indication, basically we've elected a group of people who don't believe in government and who want to completely destroy the legacy of Franklin Delano Roosevelt, in essence, and go back to a late 19th, early 20th century model. Hopefully the election's going to reverse that, but, it remains to be seen.
Yeah.
And there's a big question mark about that.
There's one thing you say that I find that I wasn't aware of, and I'm glad you brought up, and that's the idea that the education department is actually trying to funnel money towards privates. Privates actually had access. Most privates aren't like large companies, and they all had access to PPP. All of them. Like maybe not the Harvards of the world, but local private schools all had access to PPP. And I would imagine that most of them, took it because they had to keep their people employed, and it makes total sense. No problem with that. But they already have their bailout. They already have their support. We need to support states and publics at this point.
Well, the refusal of the Republicans to put up money for states which are, under the obligation to balance their budgets and now have huge shortfalls, it's all part and parcel of the same scenario, and it's quite distressing. And, hopefully we can turn it around. But I think that there will be an impact on the market at some point, and I just want people to be aware of that possibility and not get too comfortable about the fact that we've kind of returned to a good place.
Yeah.
Because I think it may be illusory.
Yeah. I don't like to call what's going to happen next ever, but I think we just have to be aware that, again, we don't know. Like we don't know.
Exactly. I just think there's a strong possibility.
Yeah. Volatility is real, and we've had a lot of upside volatility in the last month and a half, 3 months. So we should expect volatility to continue in both directions. We have about 6 minutes left. And I just want to make sure that if any of the folks that are attending have questions, we can sit here and pontificate and guess what's important to you. But if any of the folks that are here on the call want a specific answer to a specific question, don't hesitate. Pop something in the chat, pop something in the Q&A. We're happy to stick around and answer that. If there are no questions, then I just want to say thank you for everyone that did attend, and those folks that aren't attending. Then you'll get to see this on our blog in about let's not be too hasty. Maybe 4 days. I don't know how long it takes us to put these things up. We're not technology folks, but we're going to get it up there for sure. And if there are no questions, I think we're good. Scott, did you want to add anything else before we close?
I think it's interesting that David was talking about volatility, because even though today the NASDAQ was roaring and hit all-time new highs, there was a ton of volatility just today, which I think the NASDAQ's now been down 4%. It dropped almost, I don't know what it was, 390 points from where it hit earlier this morning, which is kind of a big move on an index that's 10,000 and change. So I think David's right. I think on some level, to not expect volatility would be a mistake going forward.
Well, I think part of the pop in the market today came from the fact that two of the pharmaceutical firms got to
Pfizer,
a certain place with the FDA, which means that they're on some track. On the other hand, I think it's also, that's a blip in the market because it looks good, but the reality is I don't think we're going to have a vaccine for at least another year at the earliest. So
We did get a question come in. What about rental properties? Will landlords be protected too?
Yeah, that's this is a great question because whether it's commercial or residential real estate, we've done this great job of protecting all the small businesses, and especially I don't know about nationally, but in California and specifically, I think it's in Contra Costa and Alameda County, both. We've basically told small businesses, hey, you don't have to pay your rent until November. You know, that's great, but if you own the building and you don't have people paying rent, and you don't have one of the mortgages on the building that you get to defer, where do you come up with the cash to pay your mortgage? And it's, we definitely have a bias towards protecting the small business and the person that's renting, and we have a bias away from the holder of the real estate itself. And so I actually don't anticipate that changing. I think that the way that our system works, that if you are a landlord and you have tenants that can't pay their rent or frankly choose not to pay their rent because they don't have to, I don't think that you're going to be protected. I think there are some that were protected because there were negotiated mortgage deferrals, forbearance with some of the bigger banks and some of the federally backed loans. But if you have a smaller bank and that bank is saying, hey, you got to make your payments, then you have to make your payments. And it's unfortunate that there are pockets that fall through. And that's the reality of it. I don't think that changes, unfortunately. Yeah, and David was talking about this earlier. There are pockets, aren't just landlords. There are states that are now out of pocket for enormous expenses in terms of healthcare expenses, enormous outlays for getting their schools back up and running, enormous, but they have no tax revenues, and so those states are going to suffer. There are people who were working and don't qualify for some of the unemployment benefits, and if you don't qualify for those unemployment benefits and you can't work, you're moving out of your place and moving with your parents, so there are slivers of areas in public, in private, in business, in real estate that the protection's missed. And for folks in those areas, your heart goes out. I don't know how we can protect everybody. At the same time, you're seeing a lot of arguments about people that were protected that should not have gotten that protection. I'm not taking a side. I mean, they had to come out very quickly to say we need to do something about this, and they did something about it, and they helped a whole bunch of people, and some people they didn't. And that's a little bit of a die roll. Some people would argue they helped too many people. Some people argue they wouldn't help enough. Some people argue that there's too many cracks in the system. Some people argue there weren't enough cracks, and it's unfortunate if the person that asked that question. I'm sorry if you're in that pocket where you didn't get any support. Hopefully tenants ultimately do pay their rent, though I think that's a question that we'll have to wait and see if they do. And we're at 12:45. You guys that are panelists here, if someone needs to go. I'll hang out for a couple more minutes to see if another question arises. Thank you everyone for coming. And if we'll be here in 2 more weeks, we'll do another one of these, and I look forward to that. In the meantime, if you guys have questions, you can always reach out, email one of us in the office, and we'll try to answer the question in the meantime. But we'll be back here in a couple of weeks, and I'll be on for another minute if folks have anything else to say. Thanks, everybody. Thanks, Scott. Thanks, John. Thanks, David.